there's a bit of a trend here. It's an exciting time for investors.
And this one's 5.68.
Yes.
A lower interest rate is amazing, but as a property investor, there's a few things about lower rates that can hold you back. Morgan Bushell, property investor and mortgage broker for Full Circle Finance, illustrates the importance of understanding the whole loan, not just the interest rate, by using the example of two different couples.
To kick it off with the savers, they've got this really cheap rate. It's a bit hard to grow their portfolio. For our savers, their net worth difference after 10 years, we're looking at 1.39.
The investors, what are they looking at?
2.6 mil.
What is that, 1.2-ish difference?
Yeah.
What do people need to know and what do the people need to ask?
In order to get this, you need to have solar panels on the property. How can I release equity and will it be easy? They can eventually get some access to that equity, but the main focus for them with this is
I am super pumped that the rates have started to come down from banks already, but I also want you guys to be cautious before you switch and to understand how to look at this through the lens of a property investor, which is exactly what we'll be doing in this episode. My name's Todd Sloan. This is the Pizza and Property Podcast, and this episode is powered by Suburbs Finder, Investor Kit, Full Circle Finance, and Property Strats. More about our amazing show sponsors in the show notes below. But right now, let's jump into the episode with Morgan Bushell. Morgan Bushell, how are you?
good. Thanks, Todd. How are you?
Man, pretty good considering interest rates with a 5 in front of them seem to be appearing again. How do you feel about all this?
It's exciting times. It seems like there's a bit of a trend here, and yeah, it's an exciting time for investors, homeowners in general as well. So yeah, it's keen to see where things go in the future too.
Yeah, man. And point of recording this, like we haven't actually had a rate adjustment yet. So the fact that this is starting to go on offer, I mean, people have been talking about rates coming down for quite a while now. Obviously no one's got a crystal ball, but it's like, it's kind of edging towards, yeah, this is looking like it's potentially going to happen.
Yeah, 100%. And I mean, some of the banks are adjusting their own rates independent of the RBA. So, I mean, there's a lot of smart people that work in these banks. So I guess maybe they see something coming up and as a result, yeah, they're changing the interest rates.
Love it, man. So the purpose of this episode is really pulling apart. Morgan's put a ton of work into the background of this one, is about the interest rates that we've got on offer right now, the one that Morgan's actually about to pull apart, but then really looking at the scenario of the savers versus, I was about to say the growers, but then that probably doesn't sound good, the investors, let's say. But they're both investing. One of them is a little bit more investment focused than the other, and the other is a little bit more savings focused.
Yep.
So is there anything you want to kind of set the stage with first, I mean, in regards to this rate, and then we can start sort of pulling apart the situation? Yeah,
definitely. I mean, I think before we get into it all, particularly for the couple who are the savers, for example, so the type of interest rate that we will unpack is there's a few things that come with getting that. So, for example, in order to get this, you need to have, for example, solar panels on the property.
Got it. Okay.
There's also quite a few restrictions with the particular bank as well with what you can do later down the line.
What do you mean by that?
As in, they're not as flexible when it comes to helping, I guess, release equity to then help you buy more properties as well.
Gotcha. So you might have a couple $100,000 in equity that you should be able to access that might be kind of locked up.
Exactly, yeah. Like they're not as flexible and their policies just aren't as, I guess, investor savvy.
Right. Okay. So you need solar panels. Is that pretty common? Like, is that like a green loan or?
Yeah, it's that type of loan. So look, there definitely are banks that do offer this, and as a result of being more, green and eco-focused, they pass on more of a benefit to you, and that's in the form of a better interest rate.
Got it. All right. But as far as the savings are concerned, we're talking about a decent saving as far as like what's the standard rate at the moment, like 6.5%, that kind of thing?
Yeah, like more or less. I mean, you're looking kind of like, for example, 6.1s, 6.2s, for example.
Yep. Yeah,
depending on an LVR and whatnot, but that's kind of ballpark with what we're seeing at the moment.
And this one's 5.68.
Yes, 5.68.
So what is the rough saving there that we're talking?
So the saving per annum on this between both of these scenarios is about $2,250.
Okay, so it's worth doing. Like, I guess, on face value, which is exactly what we're going to be talking about today. So did you want to start walking us through the scenario of the savers versus the investors?
Yeah, absolutely. To kick it off with the savers, so again, they've got this really cheap rate, and because of the type of loan and arrangement the bank they've got, it's a bit hard to grow their portfolio because, like we just unpacked before, it's extracting equity is a bit difficult. So I've kind of gone with the idea that over, for example, a 5-year period for both of these people, the people who are the savers, for example, they only buy their first investment property at third year. And then after that, they then buy their second at the fifth.
Gotcha. Okay. So year 3 and then year 5, they're making 2 purchases, or like making a purchase each year.
Yeah, that's right. And
got it.
It could be for a number of reasons. Like maybe eventually they realize that this particular bank doesn't really help them, or they can eventually get some access to that equity. But yeah, the main focus for them with this is they're wanting to save as well.
Got it. But they've got a cracker interest rate.
Oh yeah, like it's sensational. So yeah, it is what it is. And then if we were to compare it to the couple who are the investors, so I've kind of based it on them buying an investment property every year. So one every single year up until 5 years down the line. So
Right.
they'll have 5 investment properties.
So year 1, year 2, year 3, year 4, year 5, and they go. And what kind of value are we talking with each of these?
Look, it's hard to forecast of what's going to happen in 5 years from now, but I've kept it at a pretty clean $650 purchase price.
Got it. Okay. I'd say even 5 years' time, you're going to be able to find $650 somewhere. It
For sure, yeah.
might not be where it is exactly now, but yeah.
Yeah, there's many opportunities around the country, so sure, let's go with that.
Cool. Okay. So in 5 years' time, they've both got a portfolio. One of them has a portfolio of, is it 2 rental properties, the savers?
Yes.
And one of them has a portfolio of 5 rental properties.
Yeah.
Okay. And the investors are obviously paying a higher interest rate. How much higher are we talking? What are they paying?
We're going pretty conservative here, so we're going with 6.69 for investment on 5 years interest only.
6.69.
Yes.
Okay. All right. So 6.69%. So like an extra percent.
Yeah.
Yeah. Okay. All right. So 6.69. So tell me what happens after year 5 then. Are they kind of getting active, renovating, developing, or are they just kind of taking a knee and letting the market kind of do its thing? Like what's the go?
Yeah, so for both of these couples, we've done the scenario where they just take a knee, so they don't sell anything, they just sit on it and really see what happens over another 5 years beyond that.
Got it. So what does happen?
Well, this is where the magic happens.
Yeah.
So, to start off with, the couple who are the savers,
Yep.
they're going to be saving more money every year. And this is purely based on the loans. Like we're not factoring in rental income or anything else like that. So after 5 years, for example, they're going to save about $100,000 just in repayments and interest repayments on lending.
$100,000.
Yeah.
So, okay. So we're talking decent. That sort of like $2,000 a year that you initially said really adds up over time.
Yeah, and there's good assets aligned to that are income producing, obviously. So that's something that we've kind of parked off to the side. But purely focusing on expenses just from the bank, that's how much they're going to save.
That's awesome. Okay. All right. So $100K savings. No one's going to be unhappy with $100K savings. But the whole point of this episode is, what does that come at the cost of? Because if you can't pull your equity out, especially if you've really chosen well, you've done your research, you've made an amazing investment, if it's kind of locked up, it's not bad, but it could be a lot better, which is exactly the comparison we're about to go into. But so can we start looking at, we fast forward in the clock 10 years, the savers are still making some good choices. What's their portfolio look like after 10 years?
Yeah, so after 10 years, so holding an E, taking an E, I should say, after 5, looking at 10, we're looking at a portfolio value of 2.97 mil.
Okay, so still pretty amazing result, 2.97 million. But I've got a feeling your comparison of what the investors have got portfolio-wise is going to be pretty different. What are they looking at after 10 years?
I can't believe it. It's insane. So they're looking at a value of 5.75 mil.
5.75 mil. Okay, so it's not just a touch extra. We're talking about a lot. But now let's talk about the actual equity position difference. Like what's the net worth difference?
Yeah, so for our savers, their net worth difference is after 10 years, we're looking at 1.39.
1.39. Again, if you've achieved 1.39 after 10 years, you're pretty happy. But if you then talk to the investors across the fence, what are they looking at?
2.6 mil.
2.6. So what is that, 1.2-ish difference?
Yeah.
I could do a lot with 1.2 mil. You know how many jet ski safaris that buys you?
Quite a few, I can imagine.
Yeah. I actually don't like jet skis. I don't know why I said that. But so 2.6 mil versus 1.39. Now, the reason that I was so pumped to make this episode when Morgan and I were talking about this is because the face value, who wouldn't want a lower interest rate? Of course you would. But I want to start segueing this into what questions do people need to start asking their broker, because I still want the lowest interest rate I can. So does everyone watching this. So do you as an investor.
Yeah.
But what's that difference between getting the lowest interest rate you can and getting the lowest interest rate that cost you a $1.3 million difference over 10 years? What do people need to know and what do the people need to ask?
Yeah, so I think it really comes down to, like, what are your goals? Because yes, like saving on money and interest rate repayments is important. But if the goal is to, have a comfortable life in 10 years' time with a higher net worth, then it's kind of like, okay, how are you going to support me with my goals? And like, what does this bigger picture look like as well? So you as an investor broker with my goals, how are you going to help me with that?
Love it. All right. Walk me through the top 3 questions we can leave people with today that they can ask a broker to make sure they're balancing that little careful balance between still getting a great rate, but not at the cost of what they're trying to achieve investment-wise.
Yeah, so first thing is, how can I release equity and will it be easy?
Okay, so how can I release equity? Will it be easy? And what are they looking for? Is it like a straight up yes or no, or they're looking for kind of variables in that answer?
There's probably some variables to consider, like the limitations of whatever banks it is to then help you do that. Yeah, so I consider those things when someone asks me that question.
Perfect, so releasing equity. What's number 2?
So thing like I'd need to consider is, are there any restrictions with the types of banks or the loan products when it comes to like eco-friendly type lending?
So like the solar panels example that you gave in this.
Yeah, do you have to complete a checklist? Do you need someone to inspect the property to make sure you actually have them on the house? Stuff like that.
Okay, and so there's other things outside of solar sometimes that a lender might require.
Correct, that's right.
Got it. All right, and what's the third one that you want to be asking?
The third thing you definitely want to consider is cross-collateralization, in the sense that you don't want that at all.
Which is a whole nother episode in itself as well. But cross-collateralization as a very high level is essentially 2 titles being tied to each other instead of like pulling out equity, correct?
That's right.
Got it. And some lenders will require that to actually get like a rate that you're after.
100%, yes.
Got it. Okay, so no cross-collateralization. Find out what the restrictions are, or actually find out if they require cross-collateralization, find out what the restrictions are, and also find out how easy it is to get your equity out. Morgan Bushell, are there any final words of wisdom or anything you'd like to leave us with today on this one, mate?
I think we touched on that really well, but I mean, it all really comes back to what are your goals? Because then, like as investor savvy brokers, we can work backwards to then help you achieve that with what we know about lending.
Love it. Morgan from Full Circle Finance, thank you so much for jumping on the show, mate.
Thanks, Todd. Appreciate it.